Hi everyone, this is Ben. I do the All in the Reflexes Substack. You can find me there or on X. I'll post really frequently on X individual ideas that and interesting things that I come across. Um, Today is Sunday, October 12th, and I thought I would share a video update to walk through some of what we've seen over the past week, some of what we could use to help anticipate what's next to come, and then when I publish this, I'll also have on my Substack a survey. I'd like to do we haven't done a chart request live call in a little while, so. I'd like to do one of those maybe Tuesday after market close or during the afternoon one of the days this week. But I'll send a survey and I'd like to get opinions on what are good days and times that the majority of the group would be interested in attending. We'll walk through, and none of this is obviously none of this is financial advice. This is my interpretation of things that we see. I take action on some of what I see, but I like to use this as a way to keep a record of my evolving perspective on markets and identify strengths and areas to improve. So I always love to start these with a quote. Sir John Templeton is probably the most famous quote is that bull markets are born on pessimism, grow on skepticism, mature in optimism, and then eventually die in euphoria. And so I guess that's where we're at now. Is we'll be challenged over the next several days to determine whether we've still got a bull market that is growing in a skeptical environment, or if we may have just died on euphoria. I tend to believe that we'll continue to a bullish finish for this year, and but that's my unchanged outlook, I guess. But while this quote is probably my second favorite from him, and we're trying to produce. I'm trying to produce superior performance in the market, and I'm doing that by focusing on things that I don't see the majority of people doing, that are things that also work for me. So that's what I'll share. Some of what I'm doing in that regard, and then we'll take it from there. So this week will be interesting because the banks are. So Monday's a federal holiday. The banks are closed. The bond market is closed. Stocks are going to trade, but they won't settle until Tuesday. So I'm not sure what that'll mean for institutional involvement, and if some institutions won't be trading on a day that they can't settle, and if some of that could have fueled the activity that we saw on Friday. So when we get into the charts, I'll show how I use a time-weighted average price on an intraday chart to identify whether or not we're seeing institutional volume. So we'll get into that a little bit later. So a lot of the macroeconomic data is not coming out because of the government shutdown. So this week would have been, PPI and retail sales and things like that. Next week, though, I've read that the CPI will come out, and the CPI is not the Fed's preferred measure of inflation, but given the limited availability of data during the government shutdown, they might put more emphasis on it. So that'll just be something for us to stay aware of. I expect the market probably will respond to that figure, whether it's favorable or not. In my opinion, if inflation is as long as it's gradually decelerating, or even if it's increasing a little bit, that should be strong for the outlook for equities. The faster that that monetary policy has to ease, it signals a weaker outlook on economic strength going forward. So we really want to see these things with a gradual slope to them, either increasing or decreasing. We'd like it to be gradual, but that's my opinion. Earnings are starting to kick off. Earnings Whispers is my favorite calendar for earnings schedule, and this week the banks kick off. And what's important about that is we don't have this economic data coming out. So there's a couple of ways that I think the bank data could play out. They likely have had a very nice quarter because we have a lot of brokerage activity. We have M&A activity, IPOs. There's a lot of financing at the commercial level for the AI space, and AI has been most heavily adopted in the financial sector. So they should have top and bottom line good news for us. But we know that a lot of the banks are very cautious in their forward guidance. So we could see a really great quarter from the banks, but if they're giving caution and hinting at a little bit of fear for the way forward, to kind of hedge themselves for a strong fourth quarter, that the market might read into that as economic conditions being worse than they are, just for lack of other data available. So that's I guess I just don't really have a good feel on which direction it'll go in, but I'd like to see what's the overall tone from a handful of the largest, and then what does the market do with that data once it gets it. If the banks do very well and give strong forward guidance, I think there might be an opportunity for us to take a look at fintechs, things like there's a company called Toast, there's a company called Selv, and I think either of those would be something to take a further look into if again, if we get good guidance and good forward outlook, a good performance and good guidance. So we've got a lot of the market's reaction was the issues between Trump and Xi in the tariff battle with China. This is from Marco Papik, and these 7 steps Trump goes through in each of these negotiations. So I don't take a political opinion into this publication. I really just want to stay focused and objective to how markets might interpret the data that they're presented with, so that I know what to expect. And in this case, what we saw on Friday is step 5. We thought that we were coming up to a good place with with the negotiations, and then all of a sudden, Trump might not go, and China's dialing up their stance. So this is followed then by a makeup session, and then eventually making a deal and claiming victory for whatever the terms of that deal are. And that's the pattern. We've seen it play out over multiple things, and I don't have any reason to expect that this will be different. So what do we do with that information? We know that there's some companies like I'll pull up a chart real quick. Let's see. We've got some companies like the the materials plays, the rare earths and things, and these have had just a phenomenal run over the past few weeks, and that's a situation that's created by these exports being restricted by China, and so now the U.S. has to invest in producing as much of them as they can domestically, despite that being more expensive. So this is a self-created situation, and if it's resolved, and the U.S. is able to get rare earth minerals from China again, even in limited supply, we could see strong price reversal in things like MP and USAR is relatively newer one, IPO'd in 2023. But look, you got these massive parabolic run-ups, and resolving these trade restrictions would likely reverse price on these. I still think that rare earth mineral is and commodities and industrial metals are going to be an important part of trading and investing for the next couple of years, but we could see at least a short-term reversal if we get to a resolution with China. So just something to be aware of. And then we also, if we look at the drawdown on Friday, we've seen the drawdown in Bitcoin, and pull up the index. So we've seen that drawdown in Bitcoin settle out a little bit and calm down over Saturday and Sunday, and so we've got a Sunday bounce. I always, just my personal tactic, I tend to fade the action that we see on weekends, but if there was a lot of fear, we would see this continue to follow down, and we'd see these candles continue to progress down and fill some volume into this wick low that we got on Friday, and that's not happening. We can also look at the spot gold crypto, and we'll take a look at it on Kraken, and we can see that gold isn't, it's kind of pulled into a flag and it's picking back up, but it's not, we're not getting a fear response out of the price of gold over the weekend. So we need to see what kind of follow through we get on the movements that we saw on Friday. But what this is telling us is that the big plummet in crypto, we've got a couple of funny things going on here where we had people shorting right in advance, like right up to the minute before the Trump gave that announcement, and then we've got this technical issue that was on Binance where it was manipulated in between the announcement of the issue and the resolution of the issue, and so these things are telling me that maybe the drawdown was leaned into circumstantially and not something that'll see a ton of follow through. But again, we're going to use objective data to help guide us there. I'm really looking at some things that could, or scenarios that we could stay open minded to. So getting back over to how we saw some of this coming. So I posted about this, going back into August. I'm using this tool from Time Trades, and I'm just a huge fan of the product. So Blair does timetrades.com. He's got TradingView indicators and a Telegram group, and it's a really great group of talented folks that are much better at astrological stuff than I am. I'm very much a beginner at it, and it's just a dimension that I'm adding to my skill set. However, without a full understanding of and I may never have a full, or we'll never have a full understanding of why some of this stuff works, but we're able to appreciate it and able to use it if we can find a consistent enough approach, and so that's my focus, and continue to learn as much about it as possible. But it's offered a lot of opportunity, so I highly encourage following Blair. Margot is in his group and has a group of her own. It's a very strong group as well, and just a lot of people with great talent in this space. Marsilio is another one. You could look for him on X. I've learned a lot following all of them. So anyways, I used this anchoring from the point of the eclipse, and the way that Connie Brown writes about this in her book, The 30-Second Jewel, is the time frame leading into the eclipse and the things that happen immediately after it are like a staging period, and then a trend takes place, and it usually the things happening leading into an eclipse occur over the next 2 to 3 weeks coming out of it, and the cycles and time frames that you want to look at should relate to the dominant planets on the days of the eclipse, is like essentially the natal of that eclipse date. That's how she looked at it in the book that she put out. So I did that from the March lunar eclipse, and then we had the two eclipses in the lunar eclipse at the beginning of September and the solar eclipse near the end of September. And so one of the furthest out dates that we had on the tools anchored to the March lunar eclipse, so that we've got this large opening going into the 13th. Now, I'm not calling a high or a low based on these. I'm saying that these are dates of interest where I want to see if other catalysts align to them, and if I see a pivot or a temporary activity, I'm going to look for changes in trend, or either brief corrections when those happen. But I'm really just looking at them as dates of interest where I need to observe what happens. The other folks I've talked about are much more talented in this space, and they've got a stronger feel for whether some of this will be an uptrend or a downward reversal. And if you look at Blair's video from last week, he talks about the pentagonal cycle and that the alignment that we saw pointing to the period of the 10th through the 13th as an area for disruption. And I hit on this again last week, where I've now got these tools anchored to the most recent eclipses, and so I'm using two sets. The ones anchored to the lunar eclipse are the darker, and then I've got some that are dotted and a bit lighter that are anchored to the solar, and looking to see which levels and angles on the Ganfan and square of 9 the price responds to most closely. So taking a closer look at that, we've got, we had that date of interest on the 10th, and I did not expect it to see something this drastic. But and this is also using the volume candles so that we get a sense for the magnitude of participation in the move, and this is a pretty good sized move. So so this comes all the way down to the lowest ascending angle in the Ganfan anchored to the date of the lunar eclipse, and why that's important is if should we lose that angle and then fall further, we're going to be on we're going to see trend following descending angles on both the Ganfan from the lunar eclipse and the one from the solar eclipse. And that could take us much further into deeper areas of support in the market, and it's just a scenario that we want to be prepared for. If we take a look at it from the intraday, again, I really want to see it stay above this last ascending angle. This, I think, is going to be a very important angle for a very near-term bullish scenario. If we lose this, I think that our near-term could be a bit more severe. And so essentially we're going to be looking to stay above 65.35 to 65.50 over the next few days. Taking a look at Bitcoin, I'm doing this a little bit differently. So the Time Trades tool uses it has one tool that shows us the Venus intervals, and this is a synodic, an Earth-Venus synodic tool, and so in each stage of the synodic view between Earth and Venus, you've got different periods. Some tend to see greater levels of price movement than others, and so intervals 2 and 5 have a lot of movement. And so for Bitcoin, after seeing some of Blair's posts about it, I anchored the Mercury tool to the start of Venus interval 2. I find that the Mercury tools do really well with Bitcoin, and I anchored the square of 9 using Mercury and Venus are synodic, and you can see that we've had turning points at each of the dates of interest. Pretty close to the dates of interest for the square of 9, but these square of 9 levels and the Ganfan have been strong areas of support and resistance throughout this movement. And so we saw that we knew that this was going to be a volatile period in between the 10th and the 13th using this method, and the Venus interval 2 ends on October 29th. So I'm looking for price to stay above, get above this 115 level and stay there. And if it does that, I think we could see one more upward surge in Bitcoin after what's just happened. I would not be surprised for that to be taken as a selling opportunity by the market, though, in the near term. And then once we get past the 29th, I need to figure out what to do with for a model for myself, because this one's been really great. So those are some of the ways that we saw things coming. Another, I used this tool from the Cycle Foundation. It's a composite moving average tool that looks at the dominant moving averages and then calculates a correlation to how strongly the trend follows them. That was calling for us to be near a turning point, but it's hadn't been forecasted to be very long. So this could be a minor market correction that this would suggest what I've thought all along, that we might see some type of brief corrective period, and that would eventually lead to to a move higher. So that's continues to be my outlook. Now, other other tools that have helped us to get here. We've got this alert on the VIX is Andrew Thrasher has published a paper called the VIX Tsunami. He's also got the one called the 5% Canary signal, and we'll look at that today as well. But this VIX alert comes when the VIX and the VVIX, the VIX of the VIX, have standard are trading within very tight standard deviation. So essentially the volatility of volatility is compressed. And in times that we see that, 70% of the time we have a really large spike in the VIX. And it always resolves with a higher VIX, but the times that it is a more extreme spike, about 70%. Now, it doesn't forecast every move higher in the VIX, because every move higher in the VIX is not necessarily preceded by a state of compressed volatility within VIX instruments. But in cases where volatility is that compressed, the market's at an extreme, and it's likely to snap back in the other direction, and so that's what we're seeing. And we had a movement above the regression channel anchored to the April VIX spike, and a move below the regression channel for the S&P. So the S&P and the VIX are inversely correlated. In times that they aren't, we need to really pay attention, because one of them is going to pick a direction. But so the way that I use this tool is the VIX is now above a Keltner channel, and I'm just using standard settings for the Keltner channel if you want to use them yourself. So 20 period, 2-time multiplier, the bands are using average true range. So what happens is, now we've got a break above the channel and a break above the upper Keltner band, right? And once the VIX returns inside of the Keltner channel and the regression channel, and we have this confirmed smooth rolling top in the Keltner channel, every time that happens, we've seen the local low for Bitcoin. I'm sorry, for the S&P, and so we've re-anchored a new regression channel to April. So this is the first time that we're going to test this one, but the prior regression channel is a couple of years long. I think from the 2020 drawdown, maybe 2022, but every single time that we saw a break above the Keltner channel and the regression channel, and it rolls back over, that's our local low in the S&P. And now, ones like this are not a break above the regression channel because we've extended the regression channel. Up to this point in time, that was a break above the channel, and so just keep extending it until you get a breakout so extreme that we need to anchor a new one, and that's where we are right now. So we want to see this volatility roll over and calm down before we're comfortable that this is a local low. And I'm not one to try to perfectly time a low. I'd rather know that it just happened and then rejoin the uptrend. So that's another great method for us to know to see something like this coming. Now another is the volatility weighted put call ratio. This is using combines the put call ratio, the VIX, the average true range, and Larry Williams VIX fix, and it's using indexed versions of those and applying a stochastic up top and then an RSI below to give us a leading indicator and a lagging indicator. And so this gave us a warning that we've got an imbalance in the way that the market is interpreting volatility, and then that's breaking to an extreme, and then we got a confirmation signal, but it wasn't very strong, right? Like this is not angled downward yet. It probably will this week, and that tends to precede some of our larger movements down, and then sometimes we just get a lot of follow through, right? We don't get a lot of false signals on them. The false signals that we saw go back to like 2017. So these are three strong tools that gave us insight that we were going to see some challenges, and now we want to see those challenges play out, look for confirmation, and then get back into trend. So looking at the market timing models. Let me move this onto screen. So we've got the 10 tools that we use to look at market timing, and even though we've had this big move on Friday and in the market saw some panic, this is still very bullish. This is a very bullish environment, and we don't want to overreact to it. We want to see. I don't want to overreact to it. I want to see confirmation of either continuation higher or risk of a further downside move. But we've got the tool that I swear by is Andrew Thrasher's 5% down if that occurs within 15 sessions of an all-time high. And that looks a little scary right now, but it hasn't given us hasn't moved to yellow yet. In terms of like once we break below that 5%, that's an alert, and then it's confirmed if we see two consecutive closes below the 200-day moving average. So we're not even into the alert phase yet with that. We still have the majority of companies. This is not accurate. I need to update that sentence. But we still have the majority of companies trading above their 200-day simple moving average. The put-call ratio we just looked at. Total return. So this is where we look at the both the rate of change for the S&P plus its dividend yield, average dividend yield, and then we subtract the 3-month rate for commercial paper. And if that number is ever negative, that tends to be bad news for equities for multiple months. But this is still positive. It's falling, but it's still above zero, and it fell from last month and fell below its moving average. So that's not good, but it's still positive. These next two are slower moving, so of course they don't flip until things are really bad. Our cumulative and short-term new highs minus new lows, it remains in a positive place, but the 10-day rolling version of this is flat right now, so that presents a little bit of risk. Selling Climax gave an alert for the first time since August. We'll look at that. The extreme vulnerability, this has two indicators on it. One of them is the advanced decline line divided by its 32-period moving average, and that's bearish right now with a bearish breakdown. And so what's important here is that this indicator is rarely the low of the move when we see this downside breakout. That tends to be followed by at least a couple more days down. And then the multi-time frame momentum, all three time frames continue to be bullish. So we've got a little risk here, and our most leading indicators are telling us that there's some risk that we need to take seriously, but there's nothing here that I want to overreact to or that I'm going to make significant changes as a result of seeing. How each person manages their risk is what they have to do to be most comfortable and successful in the market. So that's again, not advice for anybody else, but this is a weight of evidence approach that I use to make sure that my decisions reflect confidence and composure. Now let's just roll through some of these real quickly. So we've got this is Andrew Thrasher's 5% drawdown signal, and we're showing it for the S&P, the NASDAQ, and the Dow. He tested this for the S&P and the Dow. He did not write about this in his paper for the NASDAQ, I think because of the amount of history and volatility in the NASDAQ at the time, but that was not part of his study. I use it on the NASDAQ because I'm always looking at these three indexes. So the reason that this indicator has turned yellow, we've had new all-time highs for the S&P and the NASDAQ on October 8th. We had a new all-time high on October 3rd for the Dow, and now we are more than halfway to a 5% drawdown before we're halfway through the 15 sessions for the threshold. So if we make it all the way to October 29th, and remember that was one of the dates of interest and the end of interval 2 for Bitcoin on those astrological charts. If we make it all the way there without getting 5% below our all-time highs, then we have not triggered an alert. So right now we don't have an alert triggered, and so we certainly don't have confirmation. And then you can see we've got the 200-day moving average is at 60,000 or 6,055 for the S&P. So we would need to fall below that for confirmation and stay below it for 2 days for confirmation if we do get an alert. We've got declining prices below the 5-day moving average, and the 5-day moving average declining. Same for the 21-day volume weighted moving average. The Dow looks the worst and is below its 50-day EMA, and that's falling as well. So that I don't like to buy. This is a Brian Shannon thing, who I followed for VWAP and Anchored VWAP, but we want to buy when we have a rising. I like to buy when we have a rising 5-day moving average, and consider the price action to be weak if we have a declining 5-day moving average. Again, we've got majority of companies in the S&P. This is the number of companies that are under their 200-day moving average. It's rising, but more than 50% are above it. So this is still bullish, and the S&P is still above its 200-day moving average. And we've had corrective moves in times where we're in that type of uptrend. So I like this because this tells me I don't want to overreact to something. If I'm a long-term trend follower, and that's what produces the maximum returns for my approach. And so I don't like being shaken out of trends too early. I like a lot of confirmation before I start to move out of the market. We talked about the volatility weighted put call. Here's our advanced decline line divided by its 32-week moving average, and we can see it's relatively rare that we get a breakout, a downside breakout, and it's the first day of a move down in the market. A lot of times this is a sideways consolidation, or is followed by some additional downside. The time that we got in August was one of the few times that that it was a singular event. The selling climax, so this is called the bloodbath indicator. This was from Larry Williams' paper, Dow Award paper last year, and we had 4%, greater than 4% new lows on the day, and that is an unsafe environment for new buying in his analysis. Multi-time frame analysis, again, bullish in all time zones. So from monthly to weekly to daily. Now this daily came down really low and will be in a bearish zone if we see a cross below 6,550, and so we're right at it. So if we move any further down, the daily is going to be bearish, but it'll take more on the weekly. The weekly's got to come down below 59.75, and the monthly would have to get all the way down to 49.50. So things would have to get really bad for us to be bearish in all three time frames. But from a multi-time frame approach, we'll follow the daily for safety for new buying, but this is not reached the level of a risk-off event without that magnitude of move. This chart uses a binary scoring approach, and I've got three categories. One is breadth, and the next is the level of deterioration in trend using moving averages, and then a scoring process for the volatility weighted put call. And it's rare that we have a signal from all three without further downside. We can get a little bit of false signal from all the first time that we see all three. Might not be the full move down, In this case, we've got one breadth signal, and then the S&P starts going back up while we're getting signals from the others. But it's when we see all three signal that's time to take something seriously. Again, over here we've got a period where we've got all three signaling when we're at the low. Trend deterioration just starting at the same time that the breadth signal flashes is tells me that we want to keep an eye on all three of these levels, and if we see downside follow through, that's confirmation that risk is materializing. When we look at the cyclic RSI for Bitcoin, we've got breakouts for the RSI for USDT dominance, and we've got a new high for USDT dominance. We need to see this come back down to be confident that Bitcoin's going to hold its price level. And I don't think we'll touch on this one today, but why not? We've got we had an extended period where the number of days trading below 1%, number of consecutive days trading below 1%, and then we've just had a nearly like a 2.7% down day, and that's actually pretty large. We don't see that many of those, and so we want to see a periods of trading days where new highs exceed new lows, and the trading range is less than 1%, are things that we tend to see in bullish environments. And as we start to get into days that where the magnitude of price change exceeds 1% and new lows start to exceed new highs, that's a bearish and risk off environment. So we've just got our risk off signal on this one, or a risk signal. But this one's very noisy, so I don't use this one for decision making until I see it accompany a trend. And what's interesting is, the VIX signal is on this one, and this experience in August of 2024 would lead us to believe that a combination of these things is pretty ugly. But if we go back through time, these VIX signals, they don't always precede a really, really big drawdown. You get them in the context of continued uptrends a lot of the time, especially when they're accompanied by lengthy periods of narrow trading ranges and new highs exceeding new lows. These periods where you don't have a lot of new highs and new low, your new high, new low is choppy. That could be a bit riskier, but I don't know. It's just not something I'm seeing signal big drawdowns like the 5% signal does for us. When we look at risk appetite, this is a complicated, well, not very complicated, but it's just a formula that looks at utilities and staples divided by the S&P. So that's a relative strength to the S&P, and we're subtracting that relative strength. Those are risk-off sectors, and so we're subtracting that relative strength, or from that relative strength, we're subtracting the technology sector and the consumer discretionary sector strength relative to the S&P. And so if we're in a bullish environment, this line is falling, and if we're in a bearish environment, it's in a risk-off environment, it's rising. And so right now it's curled upwards. This indicator at the bottom measures the distance between this line and a lower Bollinger Band, which is not displayed. So it's calculating what that band would be and how far away from it is. And so it's curling upward in its trend, and it's starting to pierce a threshold where we see a more choppy trading environment. And so this tells us the market is letting go of some of its risk appetite and starting to prefer defense. And that's a trend that we have to keep an eye on. We talked about multi-time frame. So I'm going to pause it here, grab a drink of water, and then I'm going to post a follow-up where we'll talk about how we want to, how I'm going to look at the market going forward for confirmation of directional movement. and then I want to take a look at a couple of sectors that gave us weekly signals, and a couple of individual opportunities that gave us some unique signals.